Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Right, so hi guys, welcome back to the Greedy Trader channel. Right, so welcome back to the channel. For those of you who are new, then I'm sure you're in for a treat. But anyway, I'm just going to dive straight in because this is going to be a session that is built on supporting what I've already done with the mentorship program, so the professional trader mentorship. And so I've got a series of lessons. So if you don't know anything about trading, you're completely new, or you don't know anything about investing, what I do is I cover it step by step. I think it's important these days just because there's a lot of stuff about, and it's important to know who is telling you what. One of the things I do in that program is I provide ample proof to show that I know what I'm talking about. So if you haven't checked it out yet, just go to the playlist for the mentorship program, which is on my YouTube channel, and you should be able to see the entire series. It's hours and hours and hours of content. But one of the things I did say I was going to do was to do standalone sessions like this, where you can get to see a lot more in terms of how we would approach this day to day, so you kind of get a bit more of a dynamical look. Because I think when you teach people, or when you're showing someone something, they often don't get it first time, because you're looking at historical charts, and it's not as authentic. And I'm aware of this as a professional trader and investor, and I've been doing this for, well, God, it's almost when I think about the time, that's 17, 18 years. So I've been doing it for a long time, and I keep saying all the time whenever I do this, I've been trading for over 15 years, but it's been a lot longer. And one of the things that I picked up along the way is that there's no substitute for actually showing someone something in real time. So you see I've got my trading view up, and I'm going to be able to walk you through at least the past day or so. And today we're going to primarily focus on the currency side, the FX side. I think through the program, there's something that I actually say is that it is incredibly difficult to trade Forex, as opposed to, say, stocks, for example. So balancing a portfolio, this stuff is fairly simple. If we're going to compare it to Forex, I mean, it has its challenges, but it's definitely simple relative to trading Forex. So I think that's important to know. But also, I've given within the course, and it's all free, by the way, guys. Within the course, I actually go quite in depth in terms of understanding, if you were trading Forex, how you would do it. So these standalone sessions are kind of off the same vein, because in the end, FX is just another asset that is paired against the dollar. I mean, everything is contra the dollar, so in a way, it shouldn't really matter. Usually, you get correlated moves, but I think a lot of people are intraday traders on Forex, and today we're going to talk a lot about how you would tackle this on the intraday. Again, following the steps that I put in the mentorship program. I'm not going to go into those today because there's something that will ultimately teach you how to do that, so it doesn't make sense for me to go into that today. So today we're going to focus primarily on the intraday for cable, which is the British pound, for those of you who don't know. Okay, so let's look at what's going on today, most importantly. Now, it bears relationship to what's happened in the past, because if you recall, if we go back to the weekly chart, so if we take our top-down approach, in fact, some of the drawings I made from the previous lessons are still on there, but you can actually see that when we pull back here and we started upwards, we're expecting us to trade a little bit over 131. Now, why are we thinking this? Well, first and foremost, there's going to be a lot of stop losses. Liquidity in general is going to rest above those highs. So it stands to reason that since markets move from liquidity lows to liquidity highs, that we're probably going to trade up here at some point. Now that's a long-term picture. Obviously there's all kinds of analysis you could do here. I mean, you could go for Elliott wave, for example, or you could go for Wyckoff, whatever it is your fancy. This is the macro picture, so we can get a little bit creative because there's no short-term risk. But once we start thinking about things in the context of short-term risk, then we got to dial down a little bit, and we need to start heading for more robust theories in terms of investing and trading. We can't rely on just the stuff you generally find. And what I'm talking to you about here, what I'm teaching you here, no one's going to show you this, right? And this channel's pretty small. I mean, for the most part, I haven't been that kind of YouTuber, so I've created a lot of content, but I haven't really positioned this in a coherent way, so it's been lots of bits and bytes. So I think over the last part of 2023, 24, I've decided I'm going to put a lot more stuff together, so it's a little bit more cohesive for the benefit of the channel, of course. So again, another reason for you guys to like and subscribe, so more of this content can be available on the internet, because again, there isn't a lot of what I'm telling you. There's a lot more other stuff in terms of, yay, all the fluffy stuff, make a million, make it, prop firms, whatever it is that, that takes your fancy. There's a lot of that going on, but there's definitely not a lot of channels that will just consistently give you a lot of good information for free. And no doubt there are people who are even pretending to give you good information for free, but then again, it's another story in itself, but I won't get into that. So what you find me doing here today is trying to impart what has been more than a decade worth of knowledge, really. And that's what I'm trying to do here. So again, like I said, you want to start to rely on a lot more robust theories and ideas rather than some of the stuff that influencers might put out there, because they know it's easy for you to digest, so why not? So anyway, back to the lesson. So we expect us to trade above 131, and the only reason why we expect that is because we understand how liquidity is created, so we understand how a market is made. And in order for there to be buyers, there needs to be sellers, and vice versa. So the market's trading up here, then they're going to be the most buyers up there, and that's because sellers would have their stop losses up there, for example, and those will be buy stops, and also any kind of confirmation type trades like stop order trades, for example. So any buy orders to continue in are going to be there. So it stands to reason that above highs tends to be where most liquidity is in the opposite direction. It's really bizarre, isn't it, when you think about it? Is that, well, the market's at the top here, why aren't there more sellers? Well, there you go. It's just how the business is. I mean, it's a tough explain, but why are so many people wanting to buy here? And I think a lot of it is down to the modern notions of risk control and the fact that we just don't have enough capital to keep holding on for dear life forever. So we need to have another or a counter order in place, and that's where the liquidity comes from. So some people have described this in the past in different ways, very conspiratorial in nature. So they might say things like, I've been stop hunted, but really smart traders have developed algorithms that are going to be able to do this activity. They're going to find where the liquidity is with a high degree of certainty. That's why we have high frequency trading firms who have a lot more complex systems. So with a high degree of certainty, they know where orders are. Plus, banks will sell their order flow. So there are a lot of reasons why people are going to know where the orders are, right? So it's not like I always say, it's if you're new to this, or you've walked into the freaking belly of the beast, you've walked into the circus literally. But anyway, so this is where we're going to find the most liquidity, right? So for that reason alone, I'll be relatively bullish to the top. So if I'm intraday trading, I have this information. I understand, well, there was long-term liquidity here. We can see that activity through the board. Some of this stuff I talk about on the course, but we also, let's widen this up a little bit. We can see there was liquidity down here, and then we rose. So we can see how the market's been playing so far. So where we are now is we've traded low, taken out liquidity here, not quite here. So the market's not very anxious to go down and find stops at 118. So it's preferring at this point in time, which is what it appears to be, is it wants to look for stops at 131 and above. So we're gonna arm ourselves with this information, because this is gonna matter when we intraday trade, right? So we have a bullish bias is what I'd like to say, because we're looking at the long term, and the long term traders or the algorithms on the long term want to push this higher, right? It means that they're just going to bid prices up, and that's that really. It doesn't really matter. It's nothing really to even do with the order flow. They're just going to bid prices up and orders are going to get filled, and you know, as those prices rise, right? So in a way, it isn't, you know, we talk about order flow a lot, but in truth what we should be talking about really is you know, algorithms and price. But anyway, topic for another day. So if we look at the short-term window, we can see that in the short-term liquidity is down here, right? So if we just put that there, so we can see we traded down and we pushed under it slightly. We did it once, we did it twice, and then we rebounded. So you kind of have to keep your eye open for these kind of moves. So 126.19 would have been a good level to get long, with expectation that the next reasonable place for liquidity is going to be up here, so just above 127.60. As you can see, we got lower highs the whole way, and it's all liquidity, guys. You know, forget about even what's happening here. This is just where sellers got involved, right? And the market, for some reason or the other, decided it was time to spool lower, right? Or to head lower, and that's just it. There's nothing else to it. Now, one of the things, like I say, I always talk to traders about the couple of things you're looking for. You want to know where the prior highs and lows were. If we're looking at this, we can see that we had a lot of liquidity down here because of the previous low that was sitting here. So you can see we traded that and we tested, and then we ran up, and this would have been the liquidity high, and then we had another one here. So we can clearly see where these stops are going to be, and then we start to turn around and head lower, right? So that tells us that, well, the first stop will be here. That's going to be the next place you want to worry about, and then there will be here, and if we don't get a response there, then we're definitely going to get one down here, right? So for the moment the market started to tear away and start to approach these lows, then it made sense that you want to be long. So how do we do that? Quite simple. On that green candle right here, so where we popped in and we traded up, that's where we want to get involved, right? Stops you don't want to make them too tight, right? You want to be dumb about this stuff, right? So you want to be a little bit smart, right? So, you know, it's not about just the risk reward and all of that rubbish. It's also about the probability of being right. So you want to bear that in mind. Again, you can see we've pushed up. Let's say you're aiming for liquidity high, let's say just before, to guarantee you get filled. And then obviously we've pushed up, pushed up. We're sort of trading now where all this heavy selling was. So we're definitely going to draw in some interest for sure. But something else should stand out for you, right? So again, in line with what I've taught in the Trader Mentorship Program, which again I reiterate is completely free. So there's no reason why you shouldn't check it out. So you can see that we've traded lower and we've tested under the low, right? So we've filled those stops, and then we're pushing back up, and you can see the higher volume that is trading at this point. And it, you know, again, float rotation as we say in stocks, but in Forex, let's just say tick volume. We want to be able to see that tick volume peaking. Now, bearing in mind, this is something I've been talking about for a good part of, well, since I had a YouTube channel, which was like 2012, about tick volume, right? You want to pay attention to this, because this is a sign that there's a lot of activity and a lot of interest, and we can see that here, right? So let's put things into perspective. We got high volume here, which what that does for you, there we go, is somewhat create a support or volume based support bracket. Okay, so we should draw some interest around this sort of level, and then we can also see that here, and that should also prevent a degree of support for you. So at this point, right, where the market is now, your first instinct is to break even that trade, right? So you don't want to carry any risk, right? So you've got no risk at this point. If this market pulls down here, you should be out. Now, the question everyone's going to ask me is, what's my cue to walk away? Well, the way, and this is the thing about Forex, this is what makes it hard, is the way this move has gone up. We've had a lot of volatility on the way up and the way down, and we can see where the volume is concentrated is here and here. So if we were to pull back, arguably I would say if we take out the low, then get out of the trade. But then again, that won't be wise, because we can clearly see that the 3, 4, 5 day volatility is quite high. So what we should really be looking for is if we trade back into this volume bracket below this liquidity, then recover, that might say to you that we have a continuation trade in the making, right? Because we'd have taken out liquidity, we can see there was strong volume support here. Now, if we trade under this, which is technically the highest volume at this point, if we start to close inside of this sort of bracket, then that would be your cue to walk away. But again, it would be you, it would be you giving away a substantial amount of profit, because that's what that will look like for you. It will be a substantial amount of gain. Well, at this point, you know, no matter where you put your stop, it was a decent 3-to-1 trade, right? Risk reward, if we're thinking along those lines. I don't like to be honest, but if we're thinking along the lines of 3-to-1, that's what you got here. So to watch that all go away to down here before you exit, which is less than a 1-to-1, could be quite devastating. I'm sure a lot of traders can identify with that. So this is the point where you say, well, the moment I saw this candle pull back, I'd either take some money off the table and then break even, or close out the entire trade and then see what happens, right? So here comes the idea about conviction. Now, what would I do? I'd hold it. And the reason being is I can see there's a hell of a lot of volume down here, and relative to historical volume, you can clearly see that this is much higher. And if this is much higher, it means that we should get a much bigger move, right? So the thinking about Wyckoffian logic or Wyckoff's theories, effort versus result, right? So we should, if we got a lot of effort here, then we ultimately should have a good result. So again, this is the thing I always say to people, is that when you're learning about these things, over the years I've learned about a lot of things, and what I was able to do is bring them into my own system, something that I can use, right? Now, a lot of people don't do that. They want to learn these methods and stick to them, considering they were sort of brought about in the 19th century. For some of them, like Wyckoff is, you know, the late 1800s to the early 1900s. So it's a very old system. Same for some candlestick stuff and all of that. They're very old. They're not really built in a way for modern markets. The only reason why they continue to sort of the only reason why they continue to sort of persist over time is because the markets are rather similar in terms of behavior regardless of the time frame. By that I mean you are going to get periods where you're going to find a market that is generally, you know, behaving like you would do in the 1900s, like times when we have the big crashes, for example, or when we see traders who are greedy, right? And so the behavior is going to be the same, and also the way orders get filled are also going to be the same. So for a number of reasons, right? Markets are going to change, but there's some principles that are going to hold true. So what I always say to people is that stay with guiding principles, and one of those guiding principles for me is Wyckoff, right? And effort versus result, it's not a trading strategy, it's just a principle. So if I see a lot of effort, a lot of tick volume being the effort, then I want to see an equal price move. If I don't see that, then I get a little bit concerned that something isn't quite right, it's not adding up. And so that means I need to be on alert. Something's changed, right? Example, same thing when we think about demand and supply. If there's too much supply, something should go down. If there's too much demand, it should go up. And if this for me is signifying demand, then this price should rise, right? And that's how I want all of us to think about it. Okay, so where are we? So now that you get this concept, right? So it's a bit late for us to be long. We should be long here, and that's why it's important. Now, for those people who say it doesn't really matter where you're long, you can, like, for example, some people think, oh well, it's going up, right? So if you say to someone this price is going up, they'd be like, oh yeah, I should buy. Or they will ask you, when should I buy? And it's really it's a weird question. And this is the point about training yourself so you become a professional, so you don't have to ask questions like that. Because really and truly, if I've just said to you that 126, that pop into 126.19, you should be where you're long, and then you're asking me at 126.96, should I be long here? And I'm thinking to myself, well, why were you not long before? And if you weren't, what's stopping you from waiting? Because rest assured, we are going to find some liquidity between 127.60 and 128.27. Nothing changes with this market in this respect. So as long as we're going to see that, then ultimately we don't have a problem, right? And to further prove my point, I'm just going to go out, and this is the importance of the big picture. So I'm just going to zoom out to the monthly time frame, right? Just to tell you, right, that these markets, they have brackets, right? So you can see my lines from the weekly here. So if we look at this over a long time frame, quite clearly the market has established liquidity brackets, right? So over $2 was a no-go because that was the high going back to 1989 and 1992 is a better description for Black Wednesday. So this was an extreme level. So at this level, no one can push this market further. It takes money to do that. And also, if you think of the market as a big contra dollar trade, so if the pound is rising, the dollar is being devalued massively, and that's a central bank effort or policy. So do you honestly think at let's say $2.05, one of the central banks don't want to take profit? Let's say you're the US Federal Reserve and you've been holding pounds as a foreign exchange reserve, and your pounds have been gaining value whilst you've been devaluing the dollar. So what's your reverse trade? Is to sell the pound and rebuy back the dollar. And that's precisely what happens at the central banking level. They're either printing money to devalue the currency, in which case the value of that currency goes down, but that new money is certainly going to buy up alternative assets. And that can be the pound, it could be stocks, it could be anything, right? And that's what brings the overall broad market correlation where everything becomes a contra dollar trade. Right? People like to overcomplicate things, but I assure you this stuff is pretty simple. So again, you can see that during this period, you can see at every point we get this bracket, and then we come into this area where we get this shift, this major macro shift where the European economies have to devalue massively. And they do that by printing money, and it should have been evident coming into Brexit. So we had the in the UK anyway, the Scottish referendum, which was around about sort of I think it was 2014, and then we had going forward, we also had the Brexit scenario, which puts us about 2016. So all of these, so that was about when it came off 150, which was about here, right? So all of these are devaluation efforts, right, by Britain in order to print more money to support the economy. And if you look at any fundamental data place like trading economics or somewhere where you can get a ton of data, right, you clearly see that during these periods there was a massive uptake in dollar reserves, right? So the Britain expanded its foreign exchange reserves in US dollars. Now, I wonder why they would do that, right? Because when they're devaluing, the dollar is gaining value. So if you're a central bank or government, why wouldn't you use and appreciate an asset to hedge all your activity? You're devaluing your currency, you're stealing money from your citizens, and the economy. What better way to protect yourself from this behavior that, buying the other side, right? So that's what we tend to see. But then the market pushes to this absolute extreme, which is below 105, and then we rebound, right? Now call it what you will, the COVID low, blah blah blah, because this was the COVID low, and call this the big debacle with the shortest chancellor of a lifetime scenario. Call it what you will. In the end, you can see that high tick volume here, and you can see that that's definitely supported by a price move. So if we're thinking long term, then we know at least that we got 143 in the pound just to chase liquidity. Well, this could be years away. It could be 2-3 years away. I mean, we could be looking at 2027 for this outcome, right? It could be sooner, but we don't want to get hung up on that. We just want to know where the bias is, right? And at every point, you can see the opportunity to be long, you can see the opportunity to be short, you can see the extreme brackets in the market. Now, will there be a time when we go back to 243? This hasn't happened since 1990. We've put in a new high in 2007. So the chances are that, yeah, you know, a few generations down the line, I'm sure I'll be in my grandfather's chair by then, you know, drooling over the coffee. You know, I'll probably be doing that. But I'm pretty sure that we will find ourselves here again. No doubt. Because again, if the US remains the way it remains, then we are likely to see more dollar devaluation in the future. And what that will do to currencies, we don't know. And ultimately, we can expect that hedging by central banks is going to push these things higher. So there's not a chance where we could say it will never happen. Because if you think about it from the people who were alive or grown-ups in 1980, right, when the pound was at it was $2.40 to the pound. You know, these people might have thought this would never happen. We didn't quite go there, but we came close. And the people who were maybe a little older in the 90s, they will be looking at this as a reference point, and then we exceeded that. So we're talking 1990 to 2007. It's an entire generation, right? You know, in 1990, I was very young. You know, I'm laughing just thinking about it. I was about, you know, nine years old, nine to 10 years old. So I was very young, and that's an entire generation. And then in 2008, as an adult, you know, I had very little recollection about this period. We're back trading up there. So tell me, this is not a conspiracy to keep societies dumb, right? Where it takes so long for assets for cycles to repeat. I mean, who's teaching these people how to do these things? Well, yeah, reality is everyone goes to university, or they go to some kind of school to learn how to manage the country, the government, the finances. So we're going to keep seeing the same things repeat. That's not likely to change. But I wanted to kind of bring you guys into the long term to show that these markets, they have extremes that play out over generations, or it could be in your very short term frame, like the weekly. You might think this is a long time frame. And then for you, the kids of today coming into the market, they think that everything happens here. They just don't really have any more foresight. So the older you get, the more you're aware that things have happened that you've seen, and it all plays into this very small micro time frame when the first person made a decision to get in this market and drive it, right? It happens at these levels. But this is not really our focus. As intraday traders, however, if you're an intraday trader, you're going to look at this a lot more guaranteed, but we still need that bias so we know how to prepare ourselves. Awesome stuff. So, yeah, I hope this was clear. So again, just to reiterate, what are we looking for? So we've already seen the liquidity low. This says no point getting involved, but it was worth a talk about because we discussed this in our training program. We discussed what's happening here, and we did say it was going to happen. And on the 24th of January, first week of January, I should say, 2024, it happened, right? And that's the point. So you always have to keep an eye out for these opportunities. So again, it might not serve you to trade every day, because really the opportunities, the two good opportunities was, we didn't really get a comeback here. So the first good opportunity was when we traded under 127.89, which was here. So that was a short opportunity with a chance to take profit close to the liquidity lows here, which eventually came. And then we had this flush where we didn't get any comeback. Right? We had a small comeback here, which would have been a short-term buying opportunity, and you might have had to juggle a bit about. So that was your second if you were in a trade. Right? This could have been a winner, loser, break even, I don't know. And then finally we had a return here when we hit, and then we pulled back up, and that would have been your buy opportunity, right? So you had 1, 2, 3. That was it. 3 opportunities over the course of, so you would have been sitting in this market over the course of, let's say, 28th of December to today. You only had 3 opportunities, right? Arguably, it's not bad, but you're definitely not trading every day, right? For sure. Now, of course, there are people going to tell me they trade for 5 minutes and you can trade every day and they make a ton, and it's fine, each to his own. But if you're new and you want to do this properly, you want to keep your money in your pocket for the most part, and you don't want to be losing and wasting your time on forums crying I'm losing all this money, I don't know what's going on, then if you want to avoid all of that, then you definitely want to focus minimum of a time, well, maximum of a time frame you want to go down to is the 1 hour time frame. You don't want to go any lower. It's possible, guys. If I pull up a 5-minute chart, I'm pretty sure I can find opportunities, but am I willing to put to work 5 grand, for example, as ultimate risk on a 5-minute chart? Because I'm going to have to. Or if I'm going to trade a small amount, why not just trade an hour time frame, right? So it doesn't really make any sense to go smaller unless you really have a high risk tolerance, because then you don't really mind losing a shitload of money in the space of 10-15 minutes. Right? And I think that's largely where the industry is pushing things, is that how much money you can lose and how fast can you lose it in the pursuit of trying to be a millionaire in the space of a week. Anyway, enough said. I'm not criticizing, guys. I know people have people to feed, dreams to have, cars to buy, and we want to go out and do that, and society drives us to be ambitious. So that's what we're trying to do with the markets, but the markets don't care, right? They don't care about your ambitions or what you want to buy. You know, it's the purest form of trade. So, you know, everyone has to take responsibility. So if you lose all your money, it happens to you. It's your business, basically. There's nothing anyone can do about it. Here we go. It's not financial advice, of course. In any case, let's move on. So again, just back to where we were. So today, what we're looking for, we don't want to be long. We definitely don't want to be short. And we have to assume that this is a consolidation phase. So we just want to wait it out. Like if we pop under 126.50 and rebound, then we want to position for the long side, right? That's how we would structure the trade. So let's put this into nice little words. So like, there we go. So I think I'm using the wrong tool here. Think about trading brew. Let me delete this. I don't want the ray. I want just the trend line. Right. So this is the level that we want to look at. Right. Remember there'll be liquidity down here, but this is the one, right? It's not, we don't care about this one. So if we poke on those lower, we want to see a nice little return, which gives us a chance to come back into 127.09, possibly break 127.29. Because we have a bullish bias, we will be more we'd be more predisposed to holding the trade to 127.60, right? And we know that we can get that because we do have the volatility spectrum to measure, so we can tell point to point that this market can do this in about 2 or 3 days. So it's not a concern. The main thing is we need to see the market trading and taking out stops. Without that, we're not going to find the fuel to go any higher or any lower. If we're trading out of these levels, the chances that we're going to go anywhere is very slim, because as you can see, we're just trading out of areas where there was heavy flow, and these are probably just unfilled orders that are now getting filled, and it's putting some sell pressure. But don't get your hopes up. Don't start thinking that this thing is gonna you know what I mean, it's gonna skyrocket to the bottom. That may not be the case, but if we do, then the next liquidity level is down here, which makes it back under 126.12. So again, I would look for a dink lower and a return, and if we keep flushing out, then we start to look at 125.06 for liquidity hunts. Guys, it's really this simple. Like, there are other things you can throw into that. So for example, you can start thinking about things like open ranges, and so you can start to gauge you know, behavior from session to session to kind of gauge sentiment. That's why we focus on those things. If you look, for example, let's take what went on the 3rd of January, for example. A lot of the volume was trading out at 3 p.m, which is the Chicago Open in the US, 3 p.m. in the UK. And then we had a late night activity about 7. I'm pretty much sure that's associated with the Fed. right? So we had all of this stuff going on, and that brought in additional volume, right? But so we can gauge the sentiment, that the sentiment is one that's trading out of news, presumably fundamental information, and a lot of this is driven by futures speculators. So obviously big business, big banks looking at position. If we look at through the rest of the day, this was the London session, this was the Asian session. Not a lot of activity. So a lot of the trades here were news driven by likely big professional traders from the futures pits who are taking advantage of that liquidity that normally comes in, and then we got the Fed. So we can use the tick volume per session to determine what the sentiment is, who's driving the price action. And I can assure you, if it's the futures guys, it's largely the banks, the big players, the dealers. And if it's on a Fed day, then it will take much longer for this to play out in terms of where it's going to go. Whilst it's a little bit different, if we say, for example, we saw a lot of the futures traders covering on the 2nd of January, we're just back from the holidays, and then we had a hell of a lot of volume in Europe, right, where we can see the sell-off coming out of Europe, right? This is why we don't touch this. We don't want to chase, because if the European traders are selling, the question you should be asking is where they're covering. You can see they started a cover in the Nasdaq Open, which is when the major stock exchanges opened. So a lot of the money would be coming out to get into stocks. We'll also see the futures traders weighed in on this. So generally, we're seeing a lot of support for the session, right? Over 2 sessions, we're seeing a lot of support. So these are the things that we really want to take into consideration and bear in mind. Well, awesome stuff, guys. I hope you like the videos. So like, subscribe, and share, and so on. But to my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?